The government next year for the midterm elections, in my opinion, is going to have to do things that are going to be viewed as printing money. I don't know what to see, whether it's tax rebates, whether it's getting involved in the housing market, whatever the case is, there's going to have to be more things that are pro-Bitcoin. It has to be.
Hello everyone, this is BTC Insight and welcome to yet another deep dive into BTC Insight. Before we jump in, make sure to hit that like button and subscribe if you haven't yet. You won't want to miss this.
For over a decade, wealth and power became hyper-concentrated in the hands of a few dominant companies, the so-called Magnificent Seven. They absorbed global market share, disrupted retailers, eliminated jobs, and reshaped entire industries. But now those same corporations, flush with trillions in capital, are reinvesting that wealth back into the system, building infrastructure that benefits everyone, particularly in the AI and energy revolution. Visser likens it to the build-out of electricity in the early 20th century. Back then, it took almost 80 years to electrify the United States, from Edison's first light bulb to a fully connected nation. Today, that same process is happening at lightning speed.
On the one side, that the market's too concentrated of wealth. Well, now that wealth is investing the money back into things for everyone in the hope that they'll get their money back. They may not get their money back in the form that they need. It might mean their equity prices have to go lower. We're not at that stage yet, but that's really the point that people need to start going through, is that if it wasn't for them taking all of the money in the prior decade from around the globe, meaning dominating market share, destroying retailers, they hurt jobs. They've created a K-shaped economy. In the end, they're investing that money back into an infrastructure which everyone gets to use. The democratization of intelligence allows entrepreneurs to rise. It allows them to do stuff. It's going to hurt public companies. If you work at a public company and you're not allowed to use AI every day that you're sitting in that seat, you're losing opportunity costs to learn a skill that can be learned in a very short amount of time. But every year that you're in that seat, you're falling further and further behind unless you're demanding to use not just one tool, not just Microsoft Copilot. You have to use all of them. And so those companies are actually investing back in here. And the point of writing the paper on the electricity side was to make sure people realized it was a long time from the light bulb, which triggered the build out of electricity grids in the US, to when people, in rural towns actually got the electricity. Before the whole country was lit up, it was like an 80-year process. We're taking that entire time and shoving it into what effectively is going to be a 7-year build out from the time that ChatGPT happened to the power and the power and the compute that's necessary. Just remember, $7 trillion. Don't invest in the Mag 7 they're the spenders. But all of these semiconductors and all of these power names, especially the smaller ones, there's a reason why they're parabolic, because those dollars are massive and they're the ones that have these people coming into the restaurant to buy their food. They just don't have the supply for it. As much as I believe the job market is going to remain weak in the near term, that is because of a displacement that'll happen. For every one person who loses their job as a knowledge worker inside a company that does knowledge work, remember, there's more people that work in nail salons, that work in gas stations. You can go through the list. There's plenty of service-based jobs of which are not going to be replaced anytime soon. So, all of these reports are really meant for politics at this point, and I think it's another sign of the K-shaped economy. It's another sign that the government next year for the midterm elections, in my opinion, is going to have to do things that are going to be viewed as printing money. I don't know what to see, whether it's tax rebates, whether it's getting involved in the housing market, whatever the case is, there's going to have to be more things that are pro-Bitcoin. It has to be. And the reason is, although I don't believe there's 100 million jobs, I think the point of that report, the one that was filed with The Economist to the Secretary of Labor saying they're worried about it, I absolutely believe that for the next couple years, people are underestimating the impact that the agentic worker side is going to have. Now, at the same time, Jensen Huang is saying we're going to need hundreds of thousands of electricians and plumbers. And, the Moonshots podcast this week, they talked about it as well. And they said, yeah, the average starting pay for this is $100,000 to $200,000. So these are real jobs. These are jobs now happening in the middle part of the country. You're going to see some of those. I don't think it's going to offset the knowledge worker side, but maybe we stay around zero job. It's really less about the firing, in my opinion, over the next year to 2 years. It's more about the displacement and the anxiety that is over people because they're going to watch as it continues to accelerate. The one thing about AI that never happens, it doesn't go backwards. It's this exponential compounding, and that's why it scares people, because the further you don't do anything, it's like watching a car drive down the street. It's like at some point it's out of your vision, and it's very hard to run and catch up to it. You have to get through. So I wouldn't take these reports as again, anything more than politics at this point, but I do think from a macro basis, it's going to have an impact on the K-shaped economy.
With the 2026 midterms on the horizon, governments will likely inject liquidity through tax rebates, housing incentives, or direct spending to support the lower half of the economy that's still struggling. He points to rising auto loan delinquencies, student loan defaults, and weak consumer sentiment as symptoms of a system where the bottom 50% are under severe pressure. And that's why he believes policymakers will turn to pro-Bitcoin or money printing-like measures, not by choice, but by necessity.
We're at some point, and again, I want to say this because I do believe the market, I heard you speak this week, and for everyone who's trading and getting involved, there's a big difference between Micron being at $60 and being at $200. At some point, you've built in at least a lot of the good news for the near term. I do think the market as a whole, sentiment-wise, because of all the things that are fairly obvious, Fed's cutting rates, markets making new all-time highs, earnings are growing, that maybe people should be ready for something that occurs. I mean, I can't remember the last time, and I'm normally pretty good with bringing out stats, but I'm going to say something that I just know. September was an up month. For September, October, November, December to not have a correction of, say, 4% is almost impossible in my mind, meaning I don't know how many times in history during those 4 months, because usually either September or October, there's a correction. Sometimes it can go in November, seldom in December, but also possibly there. I think we're going to get a wake-up call for people. So when you hear stories like this, I think it's a mini sign of COVID. Like, if we're going to keep throwing money, and I think they have to, because the bottom end of the economy is not seeing anything good happen. I mean, I don't know what else to say to people. If the job situation is not good, if sentiment is low, and if we're seeing things blowing up in kind of auto loans, if we're seeing things in student loan delinquencies, you still have the bottom half of the economy that's suffering. And I think there's going to be something that happens in the short term. So a warning sign to everyone trading stocks: be prepared for some kind of a correction between now and the end of the year. Do not worry on the AI stuff. If stuff falls, there was a negative article on Oracle this week. It fell down to about 270. When we came back in here today, it was back above 300. When these things occur, they're actually opportunities.
It's like a reset.
Yeah, I'd be trading more actively and being aware of things as opposed to just riding things right now. You can ride things when sentiment's been extremely negative, and once you get that move up like you had in April, then any dip to me is a buy. At this stage, and the way I said it, and this might be more of a Northeast thing during the during the early springtime, but when he's driving around and when he could drive, I'm like, all right, at nighttime, be very aware of deer. Drive more cautiously. Don't take your eyes off the road for even a second, because they just kind of go out. During the day, they're not as likely to do that. You're more easy to see. That's the way the trading mentality for me. I used to do that in Brazil. It was like, okay, I'm expecting vol to go higher, which means there's more opportunities, but there are also more chance to get stopped out of stuff. And I want to be in a position to add to things and trade them back and forth. So I think it's one of those times. Watch for the deer. There's been two credit events over the last 2 months. It's really been over the last 40 days. Tricolor, which is an auto lender for cars, again, subprime. And then First Brands, which is a parts supplier. Both of them involved in the car market. And both of them they're being investigated now by the feds for fraud. So you've had two events. They've both led to bankruptcies. In the case of First Brands, which is a very large one, it has brought in Jefferies into it, who was involved in it. I think their stock is down 20 to 25%. So when you have a bank that falls that much, you're starting to get some people looking around. The problem is a lot of this stuff is off balance sheet. It has a lot of Enron type kind of components to it. There's apparently about $2 billion of cash missing. So think about what FTX did to the crypto market.
So what's Jordi Visser's big takeaway? We're living through a compressed technological revolution, where 80 years of transformation are happening in less than a decade. AI, energy, and human adaptability are merging faster than most people realize. But beneath the excitement lies volatility, economic inequality, job displacement, and potential credit shocks that could unsettle markets. For investors, that means being selective, flexible, and cautious, but not fearful. And for workers, it's a call to embrace AI now, to learn, adapt, and participate in the next era of productivity before the curve pulls too far ahead. Because as Visser reminds us, AI never moves backward.
That's it for today's look into BTC Insight. If you enjoyed this deep dive, hit that like button, drop your thoughts in the comments, and subscribe to stay on top of all the latest insights. Keep questioning, keep learning, and we'll catch you in the next one.